Let's now bring on board Mr. Prateek Gupta, Head of Equities with Deutsche Equities. He joins us live. Prateek, good morning. Thank you for joining us. Prateek, last 3-4 months have been quite constructive for Indian markets, and India has been a marked outperformer when it comes to regional markets. But many experts are of the view that at the current juncture, a lot of hope is building up. Markets have gone up because of hope trade, not because of actual implementation.
Morning, Nikunj. Yes, I think you're right that there are some concerns that the market has run ahead of itself. We actually, however, have been quite bullish. Even at the start of last year, we had a Sensex target of 18,000. We revised that up to about 20,000 in September when we saw the first signs of reforms. And early this year, we've actually revised the Sensex target up even further to 22,500. So we believe there's even further upside from these current levels, despite some of the concerns which you expressed that has the market run ahead of itself. I would just say a couple of points. Firstly, I think the global environment is still very, very supportive. The worst of the Eurozone crisis, the US fiscal cliff, that's behind us. In fact, globally, Deutsche Bank is very bullish on equities this year. We think the tail risk events are now, the probability of those events has come off quite significantly. The policy outlook globally is a lot more supportive, and the liquidity outlook in particular. So that's on the global front. As far as domestic factors are concerned, obviously the government policy action is beginning to move forward. So we expect as that unfolds, you will see more confidence in the government's targets on the fiscal deficit, current account deficit, and so on. So that's point one. Second is, I think you're seeing earnings growth estimates bottoming out. In fact, you might actually see earnings surprises in the coming year. And thirdly is the RBI interest rates, which is the other factor as well, wherein we expect another 75 basis points on top of the 25 basis point cuts we've had so far. So when you have global liquidity environment supportive, you've got earnings growth potentially picking up, and you've got the RBI cutting rates, and also the valuations in India. While the market has gone up about 25% in the last 1 year, it's still not expensive. It's middling, even based on current earnings estimates. So we think there's still substantial upside even from here.
So what's the expectation, Prateek, from the budget? Do you think there are going to be announcements which are only going to propel the markets higher? Or do you think from now to the budget, the market could get into a limbo sort of mode?
See, I think the expectations from the budget are going to be focused mainly on firstly, the state of the government finances, both for this year and the targets for next year. There's still, we find, a lot of skepticism on the government's announcements that they will meet the fiscal deficit target of 5.3% this year and bringing it down to 4.8%. There's still a lot of worries on whether this will be a populist budget. Despite Mr. Chidambaram's promises, there are still a lot of investors who are not entirely convinced. Even those who believe him, they think that there's a risk that there'll be a lot of window dressing, below the line kind of adjustments and accounting jugglery, etc. These are the things we hear from investors. We believe the government is pretty determined to make sure that spending is brought under control, and there's accelerated push to cut subsidies and also for the government disinvestment program. So we think there'll be some greater credibility in terms of what the government is saying it is doing and what it plans to do, and that in turn should lead to a little bit of a re-rating and also help the RBI to cut rates going forward. So I think overall the budget is going to be a very important event, and we think there are some concerns in the run-up to the budget, but assuming the budget does turn out as the government is promising, I think we'll have a little bit of a, more of a relief rally and more belief in the government thereafter.
Prateek, now what has differentiated Indian markets from other markets for the year gone by was liquidity. India got about $25 billion, China got net outflow, Russia and Brazil, they hardly got anything. But if your view is that global recovery has started, do you think that's bad news for us? Because if the global recovery indeed picks up momentum, that could challenge the liquidity setup.
No, that's a good question. I think a couple of points over there. Firstly, is the underlying outlook for equities. We're more bullish on equities versus bonds. At the same time, when I say the global markets, and I was talking more about markets rather than the economies, from an economic standpoint, global growth is still going to be very weak. In fact, in the Eurozone, we expect a modest contraction in the first half of the year. So what's happening is a lot of the export-oriented markets are actually still suffering from low growth, even here in Asia. And also even in China, where we are seeing a recovery, we expect it to be driven more by the shift towards consumption, not so much as investments. So overall, there's still a lot of excess capacity in a lot of the other markets. A lot of the commodity-oriented markets are not likely to do as well. So India really stands out as one of the key, or one of the large emerging markets, which is largely consumption-driven. And the issues which were plaguing India were really of our own making, our policy paralysis and so on, and the fiscal deficit, etc. So those things, as they're reversing, that's what led to the first leg up in the markets. And as more of this unfolds over the course of 2013, we think India will continue to do very well the rest of 2013 as well. So I think really it's a difference between, given our market structure, our economic dependence less on exports, more on consumption. It's more of a services-driven market. And also, obviously, valuations last year were overly depressed, and we were still going through an earnings downgrade cycle. That, in India's case, is bottomed out, and we think we're probably heading upwards now.
But is the consumption cycle slowing down? Auto sales have come under pressure. If I map what top FMCG companies have reported, volume is under pressure. Are you getting a sense that because of high double-digit inflation, the Indian consumer is slowing down, and that will affect the consumption story?
You're absolutely right. I think on the consumption side, there's definitely signs of a slowdown over there. So that's in fact one of the reasons why we are actually not as bullish on the FMCG sector. This was one of our favorite sectors last year. This year, on the contrary, we are recommending an underweight stance on the FMCG sector. There are obviously individual stocks which we might like, but you're right. Consumption, the consumer sector is not the place to be as far as portfolio outperformance is concerned for this year. There's also, apart from volume growth, there's also pressure on margins in some cases. So which is why in India for this year, we're actually recommending the financials or the infrastructure related sectors as the main overweight. And also I forgot, oil and gas. That was somewhat of a contrarian call we made at the start of this year. It's played out really well so far, but we think even there's more to go.
Prateek, when you say oil and gas, what is your tilt towards? Would it be names like in Oil India where there are government stake sales likely to happen? What's the preference like?
See, over there, I think really there are the 2-3 broad themes driving our preference for oil and gas. Firstly is government policy action, which is cutting of subsidies, giving approvals for capex, and also capacity expansions. And we also expect a slight pickup in refining margins this year. So you'll have different companies playing out to different themes, but generally I would say the upstream companies and also the refining companies. That's where really our companies which have a high exposure to petchem refining and companies where projects were stuck because of capex approvals. I know yesterday the CCI meet was a bit of a disappointment, but I think as the year progresses, we'll see more of these capex approvals coming through. So I would focus on companies which are bearing a heavy burden on subsidies, and also on companies where you've got capex stuck, and that's where these are the kind of companies which will do well this year.
So between Reliance and Cain, one has an issue when it comes to gas pricing, other has an issue when it comes to oil production. Which one will be an absolute money spinner? Or both can be money spinners this year?
We wouldn't be able to comment on specific stocks, but we would generally like both of those companies.
Do you think after the kind of commentary we've got from large IT companies, IT stocks now qualify as stocks you want to buy on every decline?
Yes, I would just make one observation before I talk on IT, the stocks over there. I think one factor which I think is going to be supportive of the IT sector is that India still has a relatively large current account deficit, even by India's own historical standards. So that, in my view, should limit the scope for rupee appreciation this year. So that's a little bit of a potential upside to analyst estimates if the rupee stays flat. Most analysts, including our own, are assuming a modest appreciation of anywhere between 3 to 5% this year. So one is that. Second, as I said, while the US and the European economies are getting somewhat better, they're still in a very, very slow growth, or in the case of Europe, even a modest recession in the first half of this year. So in that sort of an environment, there's greater pressure on outsourcing, cutting costs. We are seeing the first signs of that. Discretionary IT spending is actually beginning to pick up. Pricing is beginning to come back. And a lot of these IT companies have actually, their capacity utilization rates are running quite low. So there's potential for upside surprise even on the margins front. So generally, most of the large caps, we are actually quite bullish on the IT companies, and we're above consensus on a lot of these companies.
Prateek, you talked about your bullish stance towards infrastructure. What about real estate companies? Do you think they too might have turned the corner?
I think real estate is a bit more tricky, especially for portfolio investors. One is lack of liquidity, over-leveraged balance sheets, and in a few cases, corporate governance concerns or perceptions about corporate governance. So I think in general, yes, while we should see some of these companies being beneficiaries of lower interest rates, but I think investors will have to be a lot more careful. It'll be very much a stock-by-stock scenario. Overall, in our model portfolio, we recommend a neutral weightage on real estate. And there are real estate proxies, which we find a lot of our FII clients in particular dealing with, the housing finance companies. That's another way to play the real estate story in India. But in real estate, it's got to be more about stock picking. Overall, we recommend a neutral stance over here.